First things first, we have to define what a trading plan is. One thing I need to say, it is one of the most essential keys to actually becoming a profitable trader. So, a trading plan is a set of guidelines to define your trading activity to help you focus on planning and executing your trading strategy. So basically it's just a tool that can be used to clearly define your trading objectives and help you achieve them. So in this lesson we explain and show you how to construct your trading plan and how to implement it. So first things first, you would, like I say, in trading it's just like business. So you wouldn't start a business without a business plan. And with trading, be clear about the plan. Make it what I like to call smart. We'll get right into that just now. Trading at the end of the day is a business, so treat it like that, and you will see progress within your trading. So let's look into smart now. So what we mean by smart, every time whenever making your trading plan, whenever tackling any aspect in your trading plan, just think of smart. So that's specific. You have to be specific about your target and about your goals and about your objectives when entering trades, and it must be measurable when creating your plan. So when we say measurable, we're saying how much money. You can say I want to make money per day, and then you need to know how much money per day. You need to measure that. Is it $10? Is it $5? Is it $2? Whatever it is, it must be measurable. And even your goals, you might even when you're tracking your progress, you must know whether or not you're tracking pips, the amount of pips you're making per day, the amount of whatever it is. So it must be achievable as well. And what we mean by achievable, please make it something that you know you can attain. A goal must be made knowing it can be attained. Not like one of those goals you'll be like, I'll make $1 billion in a day. No. Or whatever. No. It must be achievable. Make it achievable. If you know you're on a $100 account, make it achievable. Can I make $2 a day? Can I make $5 a day? It must be achievable, and it must be realistic. It's pretty much the same as achievable, but with realistic, what we're saying, how it's different is that we're saying that when we say setting a realistic target, it must make sense based on our previous track record or whatever. It might even be realistic to say I should make $10 a day, but is it really realistic if you're starting on a $5 account? Not really. So we must actually be realistic with our goals. And the last one is time conscious. All our goals must be time conscious, but not in the strict sense, but we must measure progress over a certain time. So you can measure progress daily. If you trade daily, then you must say maybe how many pips do I make in profit per day, or whatsoever the situation. Even if you're a monthly trader or whatever, you want to track your progress in certain time frames. If that's understandable, you have to track your progress in certain time frames. I think that's the reason why we use a time conscious approach. And one thing I need to let you know is that your trading plan is personal and should be dependent on your previous results and what kind of a trader you are. I also believe trading strategies and a trading plan are very dependent on who you as an individual are. So when you're making a trading plan, just think of who you are as an individual and how you can apply smart to your trading strategy. Whether you're developing your trading strategy or whatever, but just make it based upon you. If you're not very patient with trades and so forth, then I think it's best for you to look into scalping or whatever suits you. Even if your time schedule is not too free or whatever, you could even look into becoming a monthly trader or so forth, you know. So now we look into the why you need a trading plan. All right, take note of the smart at the top right corner. Every time think of smart. So you consider these questions. What is your motivation for trading? Whether it's to make a sustainable living, to top up your retirement funds, or whatever it is. you just need to look into the motivation of trading. Why? And what is your attitude towards risk? If you like taking chances, or you like the balanced approach towards risk, or you like to play safe, these go hand in hand. All these questions go hand in hand. You have to just match them. So if you like to make, let's say, a sustainable living, so maybe you would want a more balanced approach towards risk and reward, or to make fast cash whenever. So if you try to make fast cash, obviously you must take a lot of risks. You must take chances. So that goes hand in hand. Just match all these questions together and get your answer out of this. So how much time can you give to trading? Like I was saying, is it your full-time job, or only in your spare time, or it's just a hobby for whenever you get the chance to? So if it's just a hobby, I'd say you go for maybe the monthly trading sort of approach to things. That's a trading plan right there. We're developing a trading plan through asking yourself these questions. So what is your level of knowledge? Are you very familiar with the financial markets and most trading methods, or you know certain areas in depth but others you're unfamiliar with, or you're just getting started and only know the basics? So obviously, if you're just getting started, the first question, you go back to the first question: why are you doing it? If you're just getting started, what is your motivation? Second question, your attitude to risk. Obviously, if you're just getting started, play it a bit safe, because you're experimenting and so forth. Or if it's on a demo account, you take chances, but I wouldn't recommend that. I would recommend you treating a demo account as if it's your real money, because then emotions come into play when you actually go live. Now we'll look into how to create a trading plan. We're looking into the how. Remember, SMART. Every time, SMART. So these are the rules when making a trading plan. First things first, manage your risk. Risk management is very crucial. So like I said, back to the questions. If you like to play it safe, manage your risk very well. So you'd probably risk maybe 1% per trade or 2% per trade. And if you're maybe like to take chances a lot, then you can even go up to 10% or 20%. 20% is quite reckless, but it depends what you're doing it for. It's you. This is your strategy. This is your trading plan. You have your goals. Make them smart. Entry and exit strategies. Depending what strategy you're using, let's say for example you're using price action strategy, like we mentioned previously in our last lesson. Price action, it maybe your entry might be like if it hits the support and it's close to the support and then it's going to reverse, we're going to enter when there's confirmation. That's an entry strategy. An exit strategy, when it comes close to our take profit, or maybe we've seen like some resistance. Now at the end of the day, with the entry and exit strategy, a lot of traders lose out here because sometimes they're maybe scared or not too confident with their trading strategy. So they might pull out of a profitable trade too early, therefore minimizing their profit, yet they would wait out so long with a losing trade, therefore maximizing their loss. But it's supposed to be the other way. Maximize your profit. The profitable trade, maximize them. That's not to say be greedy, but maximize them. Trust your strategy. Be confident with your strategy. And when exiting, make sure that you're very strict. You're very strict. The same way you would let it hit your stop loss is the same way you should let it hit your take profit or whatever. It's your strategy. You decide whether to enter in a certain way and exit in a certain way, depending on your strategy. And this is part of the psychology of trading, but you have to keep focused and be decisive. So if you're scalping and you don't use stop losses, for example, you must keep focused and be decisive. You are going to be there every second if you are scalping for a scalping strategy. So you're working on the 1 minute or the 5 minutes time chart. So obviously you're going to be there watching that trade, and as soon as maybe, let's say you are very strict, as soon as it hits maybe 50 pips in a loss, you're going to close it. You are decisive right there and then. You're going to minimize your loss. And as soon as, let's say, you see a confirmation, you're going to enter. Be decisive, be focused right there. So another thing, evaluate your trades and manage your money. Okay, when you're evaluating your trades, you're going to look into your track record. How have your trades been performing? How was today? How was last week? How was last month? How's been the year for you? You're going to now basically make everything black and white. Are you in profit with your current strategy? Are you confident with it? And manage your money. Just because, let's say, you've been winning so many times, obviously every trader goes through losses, but let's say you've grown to trust your strategy so much that you lose money management, and then you just think, oh no, I'm pretty sure in these trades now, in my strategy, I'm going to risk a lot. And let's say you just get hit by a losing streak, which happens to most traders. Guys, this is just like a business. Most businesses even go through hard times. So do you as a trader. Just manage your emotions. That's part of the psychology of trading, which is another lesson, but just manage that. This is managing your money. It's the same way you should manage your emotion and the psychology. That'll be the next point now. Simplify your trading and maintain discipline. This is very crucial. Just simplify your trading. So what we're saying here is that make sure your trading strategy is clear and concise. It's not too complicated. It shouldn't be too complicated. It should be easy for you just to remember. Like, oh no, I have to wait for confirmation and I'm in. That's being decisive, and the entry of my strategy is so and so, and I manage this risk. I know I only put 2% every time. Just simplify your trading. It's easy to remember for you, so every time you're just clicking, you're not referring all the time. When you're used to trading, you're not referring all the time to your book, like you've got so many notes and you're wondering how exactly are you going to enter a trade. You understand? So just simplify your trading, guys, and maintain discipline. That is very crucial. Maintain your discipline, like we were saying. This goes hand in hand with being decisive and all the rules that are here. Maintain your discipline. You might have the winning formula on paper, but when it comes to the actual trading, you do not maintain discipline, you will not achieve your results. So now we get right into the real thing. Creating a trading plan. Remember, we use SMART. So this is an example of a SMART trading plan. Let's say we start with a balance of $100. We have a daily target of $2.50, and we use 0.01 as a lot size because that's our money management right there. That's risk management right there. Daily target is clear and concise, and we have monthly target pips. We based 800 pips based on 30 pips per day, let's say from our track record or whatever. So all this, we expect $50 profit. Maybe this could be on a monthly basis, but I didn't want to put too much a real time frame on this one, because these are targets, like we said. Normally we use the time conscious part on track record, maintaining track record, because in trading normally we find that in certain months we could go through a time where we don't perform as well as the next month to come or the previous month. So normally we prefer just to say this is an average of what we expect per month, but monthly time frames are there for track record. So with $100, 30 pips at the lot size of 0.01, that is a micro lot, we expect to make $2.50 and we're out. Alright, doing that every day for 20 days consecutively, give or take. We could make more, we could make less, but we have to maintain discipline on our trading plan, because with the trading plan it prevents blunders such as, you know, over trading. I'm sure you've heard of over trading, and this over trading, just like I have $100 balance and there you are, you trade the whole day. Eventually, most chances, if you do trade the whole day, you're a beginner, so most chances as a beginner you will end up just stopping by blowing your account if you're not using good risk management. Even if you are, though, sometimes, you know, if you overtrade, overtrading causes, you know, either an equilibrium in your profit and loss or just plain losses. So obviously we have a follow-up to what we expect after reaching our target of $50 profit, and we have that follow-up here. So we expect to now have a balance of 150. So now with the balance of 150, we move on now. Now we're using a lot size of 0.02, let's say. So with that lot size of 0.02, we maintain our monthly target of pips because our strategy, let's say, has not changed. And we know that we always get, let's say, rough estimate 800 pips, give or take. We have to be very smart with this as well. Don't expect too much, because if you expect too much, I think trading will frustrate you and causing you to trade with emotions, and that's something you do not want. You want to avoid that at all costs. Just stick to your plan. If things don't go according to your plan, it's fine, it happens. Just believe and be confident in your strategy. Alright, so with $150, a balance of $150, we expect to make now a new daily target of $5 because we're using a larger lot size but the same amount of daily pips as a target and monthly pips as an overall target. So we expect to achieve $100, and after that obviously we'll be on a balance of $250 and we'll follow that up as well, and so forth and so forth and so forth. This is growth. This is being a profitable trader. This is being confident in your trading plan. This is following, being disciplined, and sticking to it. And obviously maybe this is a more of a standard risk or low risk trading plan. This is more of a growth kind of for a daily trader. So now we have our rules for this trading plan. Our rules are simple. We enter after confirmation. For example, using our strategy, we enter after confirmation. And we place stop loss up to 60 pips away. So that's it. It's that simple, guys. It's just that simple. Anything that you can just remember. Enter maximum of 3 trades per day. This is to avoid over trading. It's plain and simple. Although that is as simple as you can get for a trading plan, and it's very effective as well. And at the end of the day, successful paper trading does not guarantee that you will have success when you begin real trading. Like I said, as aspects such as emotions may get involved, but it will give you confidence in your system or strategy. So all you're trying to ensure is that you minimize loss and maximize profits, and ensure you become a better trader at the end of the day. Alright guys, that's my wish for you. You just need to become a better trader and grow with it. Just love the process. In the end of the day, you will go through highs and lows, but every trader does. That's one thing you have to remember. No matter what you see out there, like there's no such thing as a trader who goes through trading without a loss. Losses happen, but you have to at least, like I said, minimize your losses. Just minimize them and maximize your profits. We're just trying to get the odds in our favor at the end of the day. That's why we even enter a trade, because the odds will be in our favor.